Your stock portfolio is not your wealth. It is your permission slip to keep paying taxes, fees, and losses while the people who understand the rules quietly compound theirs. And here is the part nobody wants to say out loud. You were taught to buy assets like it was a hobby, not like it was a transfer of power. In 2026, that transfer is getting uglier. AI is cutting the middle, inflation is trimming your real wages, and the housing market has turned adulthood into a subscription. This is not financial advice, this is financial education. And I am going to break down the machine behind stocks, bonds, and how money actually gets assembled, routed, and protected in the real world. Not the motivational version, the version with paperwork, the version with leverage, the version that shows why learn to code was a joke for most people, why rates are coming down did not bring your purchasing power back, and why the rich keep getting richer even when the headlines scream danger. If you are watching this at night, thinking about your job security, your rent, your savings account that feels like it is slowly freezing, you are not paranoid. You are just finally paying attention to how the system behaves. Let's start with the simplest question, the one that makes everyone uncomfortable because it sounds too basic. When you buy a stock, what are you actually buying? Most people answer with a vibe. I am investing, I am growing my money, I will beat inflation, but none of those answers explain the mechanism, and without the mechanism you are not investing, you are feeding a process you do not control. So imagine it is 200 years ago. You want to start a business that sells wine from grapes you grow. You need workers, you need tables and tools, you need inventory. You also need money that can survive time, not just money you can spend today. Where do you go to find workers? You go to labor markets. Where do you go to find furniture? You go to goods markets. Where do you go to find money? That is the point. Money is not magically free. It comes from somewhere. It has owners, it has conditions, and it has a place where supply meets demand. That place is the capital market. Capital is the money that is supposed to turn into more money, not money you burn, money you deploy, money you use to produce value. Now in 2026, that is not just banks. It is a whole ecosystem. Hedge funds, private credit firms, bond warehouses, broker-dealers, market makers, exchange operators, and regulators who write rules that determine who is allowed to play and who is forced to watch. And if that sounds abstract, let me make it real with your life. When the Fed raises interest rates, it changes the cost of money. When rates rise, borrowing gets harder. When borrowing gets harder, business growth slows, layoffs accelerate, and the people with stable balance sheets survive while everyone else gets squeezed. Meanwhile, your paycheck does not instantly reprice. Your rent does, your groceries do, your insurance does, your debt interest does. So real purchasing power erodes even if you hear a calm press conference and they say inflation is stabilizing. You feel it. But do you understand what changed? The price of capital moved, and once the price of capital moves, the entire economy rearranges itself around who can afford the new cost. So capital markets decide who gets funded, and funding decides who gets to grow, which brings us back to your question. Stocks and bonds are not the same. They are different contracts. Different contracts create different outcomes, and the differences matter more than the chart. Here is the first ruthless truth. Bonds are promises. Stocks are ownership. When you buy a bond, you are lending money to someone. You are a creditor. You get paid interest, and in many structures you get paid before the owners do. When you buy a stock, you are a co-owner. You get paid only if the company has profit after obligations. Your upside is tied to business performance. Your downside is tied to business survival. And the company can issue more shares, changing your slice, because your ownership can be diluted without your permission. Let's build the story, but with numbers that a Western investor would recognize, not bedtime metaphors. You are a small business owner in the United States or the UK. You have inventory. Maybe you have a warehouse. Maybe you have a production line. You already invested capital. Now you want to scale. You walk into a bank. The bank does not ask, how passionate are you? The bank asks, what can you put up? Collateral is the bridge between ambition and money. If your company has assets worth $10 million, the bank might lend you less than that, maybe 4 to 8 million depending on the risk. The bank wants a buffer because banks are designed to protect the downside for depositors, not to dream with you. So your original loan becomes a contract, a debt contract. That debt contract has priority. In plain language, when the business earns money, the bank gets paid first. Now picture a second scenario. You do not have enough collateral left. Your first factory has been pledged. Your next expansion needs capital, but you cannot keep stacking the same assets as guarantees. You need a different product. Someone tells you to sell debt to other people, not just to your bank. You issue bonds. Instead of one bank, you have many bondholders. You pay interest to them. Same priority logic. Debt first, equity later. And if you have ever wondered why the stock market loves share buybacks when times are good, understand this. Buybacks concentrate ownership. They can also signal management confidence. But the reason debt pricing and equity pricing matter is because debt holders demand safety and equity holders chase growth. Debt wants stability. Equity wants performance. Now here is where the story gets genuinely ugly, the part where most people stop paying attention. Most people learn buy low, sell high like it is a moral lesson. But the people who actually profit from capital markets treat the market like a supply chain for control. A bond issue is controlled by disclosure, legal structure, interest coverage, and default risk. An equity issue is controlled by valuation, ownership dilution, governance rights, and the future expectations that drive share prices. And the market is not a neutral scoreboard. It is an arena where different players with different motives constantly reposition. In 2026, you can see this everywhere. AI changes who gets hired. It changes who gets funded. It changes what investors believe will scale. It changes who can defend margins. The companies that survive are not necessarily the ones with the best product. They are the ones with the best access to capital on favorable terms, or the best ability to raise capital even when rates are high. That means if you are in a job that AI can automate, the capital market is also deciding your fate. Because when revenue drops or growth slows, funding dries up and cost cutting becomes inevitable. And you are watching the stock market hit highs or bounce up and down like it is weather, while your own life feels like an eviction notice. So why does the stock market feel disconnected? Because stocks are ownership claims on future cash flows, and future cash flows are priced under uncertainty. When investors are euphoric, they pay more for the same business. When investors are scared, they demand a discount for risk. That discount and premium is not emotion alone. It is liquidity. It is leverage. It is access to credit. Now let's talk about the classic mechanism for why stock prices swing. When the market believes profits will be high, people buy. When people buy, prices rise. When prices rise, other investors chase. That chase can inflate valuations far beyond what basic earnings justify. Then something happens: a recession, a credit event, a wave of layoffs, a rate shock, a consumer slowdown. At that moment, investors realize that their assumptions were too optimistic. Companies begin missing forecasts. Defaults rise. Supply of fear overtakes demand for risk. And then you get selling pressure. If everyone wants to exit at the same time, prices fall quickly, even for companies that might survive, because markets trade expectations, not comfort. Now think about 2020 to 2022, and then again the turbulence in 2023 to 2026. Central banks changed interest rates. Inflation damaged purchasing power. Housing prices detached from wages. Insurance markets started acting like disaster zones. In climate-stressed regions, it became normal for homeowners to see insurance availability collapse or premiums spike. All of that changes corporate cash flow assumptions. It changes household spending. It changes credit quality. It changes default probability. And default probability is what breaks bond markets, then feeds into stock markets, then hits employment. So the stock market was predicting your pain, but nobody translated it into your paycheck. And here is the part you need to understand to stop being played. People do not only trade because they want money, they trade because other people are trapped in contracts and constraints. For example, institutions often have risk limits. They might be forced to reduce exposure when volatility spikes. They might need liquidity to meet margin calls. If they are borrowing to buy assets, rising rates can force selling even if their long-term view is bullish. Retail investors, meanwhile, are often buying because they see a headline or a creator's dream of passive income. The creator economy is real, but most people making finance content are not making real money from investing. They are making money from attention, and attention is not the same as ownership. So when you scroll through social media and you see someone posting luxury while telling you the secret is staying consistent, remember, most retail accounts are not positioned like investors. They are positioned like passengers in someone else's trade. Now we are going to tie it directly to what stocks and bonds actually are, because this is where your learning should become practical in the way that changes decisions, not in the way that changes vibes. Every stock is a piece of a company. Ownership means you share profits if profits exist after obligations, but it also means you share losses if the company fails. And it means governance depends on the size of your stake. If you own a tiny fraction, you do not control decisions. You do not control strategy. You might not even have meaningful influence over risk management. You might vote, but your vote is noise compared to the major holders. That is why the I am an owner story feels empowering while actually leaving you powerless. You are allowed to believe you are in control, because believing is easier than understanding. But in reality, you have a contract with uncertainty and a queue behind creditors. So what determines whether you get paid? Not whether you are good at stocks. Not whether you are patient. It is whether the company can generate cash flows that cover debts and still leave room for equity holders. It is also whether management can avoid diluting shareholders at the worst possible times. And it is whether the capital markets are willing to fund the company when the economy tightens. This is why value investors and momentum traders can both look right in different time periods. Momentum traders ride flows, value investors ride fundamentals, but both are responding to the market's pricing of risk and expectations. Now, let's make it concrete with a real psychological cycle you have probably experienced. You buy shares because you think the company is doing well. At first, it rises, and your brain labels that as confirmation. Then you hold through a small dip because you want to believe the dip is temporary. Then you watch it fall more. Now you are no longer investing, you are hoping. And while you are hoping, insiders might be doing something else. Insiders might be selling after lockup periods. Private equity might restructure. Private debt might refinance on more expensive terms. Banks might tighten credit. Or the company might issue new shares to raise capital, diluting you while telling you it is strategic. Your emotional story becomes their financial story. That is the transfer. So if you want empowerment, you need one skill: understand the contract you are buying. The richest people are not mystics. They are contract readers. In 2026, this contract reading is harder because AI is accelerating institutional behavior. Algorithms react faster than humans. Market makers manage spreads and inventory. Institutional risk systems can shift positions in seconds. That means your timing is less relevant than you think, and your ignorance is more expensive than you realize. Now here is where the script turns from education into anger. They told you the system rewards skill. They told you your job and your salary and your hustle determine your future, but the actual mechanism is capital allocation. Capital markets decide who gets funding, and in a world where the top 1% owns more than ever, it is not just that they have more money. It is that they have more access, more legal leverage, and more ability to reshape markets through funding choices. When rates are higher, the rich don't just save, they reprice assets and refinance. When liquidity tightens, they survive because they can borrow at better terms or already hold liquid reserves. Meanwhile, you refinance once, you might lose your home. You borrow against your future income, and your payments jump. You are not building equity, you are building a chain. This connects directly to housing, because housing is one of the biggest capital markets in the real economy. Housing affordability across the United States, Canada, the UK, and Australia has become permanent damage. Wages did not rise like prices. So many people end up renting longer than they planned. And when you rent, you pay for housing without building ownership wealth. That means your wealth accumulation slows, while asset owners benefit from price appreciation. This is not a coincidence. It is a feature of a system where returns concentrate in assets and income can lag behind asset inflation. And in 2026, with climate-driven disruptions, the asset side is getting riskier too. Insurance markets collapsing or premiums skyrocketing in high-risk areas means some homeowners discover that ownership is conditional. If insurance becomes unaffordable or unavailable, the asset becomes fragile, but the wealthy can absorb, the poor cannot. So when you think stocks are the whole game, you are missing the bigger structure. Stocks are claims inside capital markets. Housing is the claim system in the real economy. Bonds are the contracts that govern cash flow priority. And behind all of that is the central bank, the Fed, and its interest rate policy. When the Fed tightens, it changes cost of borrowing. When it eases, it changes liquidity. But either way, the question is who gets access to the cheap money. Because the rich do not just borrow. They borrow strategically, refinance intelligently, and structure assets to maximize after-tax returns. And now you can see why the inflation is down news often sounds like a lie. Inflation might cool, but purchasing power does not magically heal. Wages lag, rent rises, food stays expensive, services stay expensive. Real returns depend on everything you experienced since 2019. The Fed can reduce headline inflation while millions still feel poorer. That is because headline inflation is not the same as your lived cost of living. So let's bring it back to stocks and bonds in a way that helps you resist the next trap. When you buy stock, you are not just buying a company. You are buying into a structure of priority. Debt holders get paid first. Equity gets paid last. In some cases, equity gets nothing. When you buy bonds, you are buying into priority, but you take credit risk. If the company fails, bondholders might recover some amount, but not necessarily all, and the market decides the price of those risks in real time. That is why the stock price can go down even when the company has revenue. Revenue is not profit. Profit is not cash flow. Cash flow is not solvency. Solvency is not guaranteed. This is also why debt crises matter more than people think. If credit spreads widen, if bond issuance becomes expensive, if refinancing walls appear, you get layoffs, you get bankruptcies, you get sudden unemployment. And then retail investors look at their stock charts as if it is mysterious. It is not mysterious, it is chain reaction. Now we need the next escalation. The part that connects your personal fear to a market structure. You might think you cannot be part of the system because you are not a billionaire, but you are part of it every time you put money into a brokerage account, every time you buy an exchange-traded fund, every time you hold shares during volatility, and institutional players can shape the environment around you. In the same way that someone can structure debt to fund growth, institutions can structure exposure to profit from volatility. Options, futures, swaps, prime brokerage financing, and AI-driven trading systems that react faster than your attention span. So your investment becomes a background liquidity source. Sometimes you win, sometimes you are liquidity when someone needs you to lose. And in 2026, with AI acceleration, these cycles get faster and more brutal. Now let's talk about the other promise you were sold. Crypto was supposed to be freedom from banks. But in 2026, banks own more crypto than retail. Custodians, prime brokers, and regulated entities dominate the flow. Regulation did not just reduce scams, it also concentrated power. Decentralization turned into compliance. The infrastructure became more corporate. The upside became more institutional. Retail still gets marketing, but institutions get rails, liquidity, and contract control. The same theme as stocks and bonds, ownership claims exist, but control and access are not distributed equally. So when you hear someone say crypto equals independence, remember, independence from banks does not mean independence from capital markets. It just means the capital markets changed uniforms. Now, let me make the next cliffhanger land, because this is where most people will stop and not want to hear it. The biggest wealth transfer in modern history is not just stocks going up. It is not just the housing boom, it is the combination of three things happening at once. First, wealth concentration accelerating. The top 1% owns more. That means more interest income, more asset appreciation, more ability to borrow cheaply using assets as collateral. Second, employment disruption. AI eliminates tasks faster than policy can respond. Your skills might still be valuable, but your bargaining power can collapse if demand shifts. And demand shifts when employers can replace human work with software and automation. Third, the retirement crisis. Social Security is strained, pensions are underfunded, people are told to delay retirement, and they comply because they have no choice. That delay means longer exposure to a system that keeps extracting value from them. So when you are told invest for retirement, what they really mean is stay in the game long enough that the losses and the fees can quietly accumulate while you try to catch up. It sounds harsh, but the numbers are harsh. Global debt is over $300 trillion. That is not a passing detail. It is a structural constraint on how much the world can afford when shocks hit. High debt means less room for governments and companies to cushion crises. That means when something breaks, it breaks harder.